Matrix and welcome to Matrix. My name is Looney and I'll be assisting you to get all of your questions through to us. Today we're focusing on your final exam prep for accounting. All you need to do is search for Matrix on all our social media platforms, as well as hit us up on our WhatsApp line. All of the details are on the screen. We do have a fun competition going on for you guys, so please stay tuned to get all of those details later on in the show. I've got Pumza with me, our sign language interpreter, as well as Ashraf, our awesome teacher. Thank you so much, guys, and over to you.
Thank you, Looney. Welcome, grade 12s. Yes, it's accounting. We're preparing for the final exams, and we start off by saying, don't fear when Ashraf is near. That's right. Our focus is on adjustments, and we're going to look at the adjustments, and we're going to take each adjustment and explain it to you in such a way that you are well prepared for the exams. Let's get right into it. The first thing that we look at is rent. Now, obviously, this is one of the adjustments that learners find very challenging. So what we want you to do is to focus and see exactly how you go about doing this particular adjustment. Let's look at the information. Let's start off by saying RTFQ. You know what that stands for, don't you? By now you know already that you have to read the full question. In other words, look at the information that is provided to you. Okay, so you are told that the financial year end was the 31st of December 2019. Important to know when your year started and when your year ended. You are told that your rent income figure, as it appears in your income statement, is 126,224. Okay, so that's the given information. What else are they telling you? You are told that rent was received up to January 2020. So immediately you know there's an adjustment involved. Step number one, identify the adjustment. Remember, you need to see what are we referring to here. In other words, if we have received rent in advance, immediately it must click in that we are talking about deferred income. In other words, income received in advance. Why? Our financial year ended in December and we have received the rental for January as well. So clearly you can see we're talking about deferred income or income received in advance. Okay, once you've identified that, now we go into the calculation, guys. Right, let's take it from here. They're telling you that rent was increased by 12%, so the percentage increase is given to you, okay? And step number two, you are told that it was increased on the 1st of August 2019. So clearly you can see, you do not know what was the rental per month before the increase, right? What you do know is that the rental was increased by 12% when? On the 1st of August 2019. Got it? Now, how do we go about answering this particular adjustment? Step number one, make your old rental, you don't know the amount, make it equal to 100%. There goes. Right? So you've already told yourself that the old rental, you don't know what it was in terms of rands, but in terms of percentages, you make it equal to 100. Right? Then you tell yourself, right, so the financial year started in January and ended in December. Okay? That's your financial year. So now, you tell yourself, right, from January to July, that is when your rental was at 100%. Remember, the increase took place on the 1st of August. So therefore, January to July will give you 7 months. In other words, for 7 months, your rental was at the old rental. Keep that in mind. Number two, from August to January. Now you may be thinking, why is Ashraf including January? Remember, we have received the rental for January. So you have to take it into consideration when you are doing your calculation. Therefore, you say from August to January is 6 months. Okay? Count your months and you will find that you have 6 months of the new rental. Why the new rental? Because the rent increased by 12% on the 1st of August. Got it? Brilliant. Let's move on. Now look at my calculation. 7 months at the old rental, obviously January to July, times 100. Why 100? Because at that point your rent was 100%. So 7 times 100 will give you the 700. Step number 1. Step number 2. Your new rental was for 6 months from August including January. So 6 months at what rate? Remember, the rate increased, your percentage increased by 12%. Therefore, your new rental is now 112. Where am I getting 112 from? 100 plus the 12% will give me 112. That's my new rental, which is equal to 672. Right? So I've now got my entire year, but I've got it in terms of percentages. Right? Okay, so take that. Add the 2, which will give you 1372 in terms of percentages, which is now equal to the figure that was given to you in your income statement for rent income as 126,224. Okay, now grade 12s. This is where we now do the actual calculation to determine. What are we determining? We are trying to find out what was the 1 month's rental that we have received in advance. Remember, that's the goal. That's the objective. Okay, now, and that 1 month's rental obviously is a new rental. As you can clearly see, it's part of the new figure. It's part of that. Therefore, 112 is equal to my unknown. And this is the part where you have to understand what you are doing. Look at this now. You tell yourself, 1372 in terms of percentages is equal to the rand value of 126,224. There's my equation. The 112 in terms of percentages is my unknown in terms of my rand value. So what do? I cross multiply 1372x, as you can see there, is equal to 126,224 times 112. Okay? Once I've done that, I now calculate my x to be 10,304 rand. What is that figure? That is my income that I've received in advance. So what I've done, I've calculated it and we move on. How do we deal with this in the income statement? Right? Many learners have called in and asked about the income statement. So watch. This is what we do with the income statement. When you're working with your income statement, the fact that you have identified it as deferred income, remember deferred income is what we identified initially, okay? And when you're working with deferred income, it means that in your income statement, you must subtract. What do I mean subtract? When you're working in the bracket, look at the operation. Deferred income tells you subtract that amount. Okay, so you start off with a figure as per given in your income statement, which is 126,224 minus the deferred income. Because remember, you need to account for rental for 12 months. This figure here, it has 13 months of rental in it. Therefore, we remove the 1 month. What's my contra entry? A debit to rent income and a credit to income received in advance, also known as deferred income. So therefore, you can see by debiting the rent income, you are reducing your rent income. Therefore, minus the 10,304, which we calculated, to give me my final figure of 115,920. Got that? Easy, isn't it? Wow. Next one. How do we deal with this in the balance sheet? Very simple. In my balance sheet, I have an item called trade and other payables, okay? And underneath the trade and other payables, I've got an item called deferred income. Why? Because it's a temporary liability. Understand, it's a temporary liability. It's an amount that we have received from our tenant, which we haven't earned. It will only be earned next year. So for now, it's a temporary liability. And therefore, it will be included under my item, trade and other payables. Got that? Brilliant. Let's move on to the next one. Done and dusted. Let's look at salaries and wages. Okay. The adjustment that's given to us is as follows. Your financial year, again, once again, 31st of December 2019, you are told that your salaries and wages, as it appears in your trial balance, is 175,000 and the employer contributions equal to 35,000 Rand. Now remember something else. You could get only one amount in your income statement where your employer contributions are part and parcel of the salaries and wages. It could be included. So please read the question carefully. In this particular question, they are shown separately as two separate expenses, but they could appear as one in your income statement. Okay? Just depending on the question. What are we told? We are told that one employee was omitted, left out from the salaries for December 2019. So we have to do the necessary entry. Let's go right into it. This is the information you are given. Here's your salaries journal. You are told that that is your net salary, right? What is net salary? Gross salary less your deductions. Watch what I'm saying. Gross salary less your deductions. Okay. So if that's my net salary, and if I want my gross salary, I've got to add my deductions. This one here, we will come back to just now. For now, just keep it parked off one side. We'll deal with it just now. So in other words, take your net salary plus your deductions, and that will give you your gross salary. So obviously, your 46,000 plus your 14,500, watch here, you will add it. Obviously, those two figures added to gives you 60,500. You now add 175,000 plus the 60,500. Where did the 60,500 come from? 46,000 plus your 14,500. So net salary plus your deductions will give you your gross salary. Got that? Wow. Moving on, we now come to the next one which we spoke about, and that was your employer contributions. Remember, apart from the salaries, it's very often you get employers contributing on behalf of our employees, which is also an expense to the enterprise. Therefore, what do we do? Employers' contributions, this was the figure given to me in my trial balance, add the one that we omitted to give me my final figure of 44,800. So bottom line here, grade 12s, is know that net salary plus your deductions will give you your gross salary. Okay, moving on to the next one. How do we deal with it in the balance sheet? Remember, because they were omitted, you have to include them in the balance sheet. If you're doing, once again, under trade and other payables, you've got creditors for salaries, what you owe your employees. This is what you owe to SARS, and this is what you owe to your pension fund. So you have to itemize in your trade and other payables, showing exactly where those figures come from. Okay, done and dusted. Let's move on to our adjustments. Now, let's just go back here and let's just deal with the format of the note. In other words, what else would appear under trade and other payables? What other items would appear under trade and other payables? Remember, you've got your creditors control, namely your trade creditors, right? Those are people, obviously, that you have purchased goods from on credit. Okay, and then, remember we spoke about deferred income? Obviously, that would be part of my trade and other payables. And then my accrued expenses. Those expenses that I have incurred, which I haven't paid for, would also appear under my trade and other payables. Okay, now obviously at this stage in your preparation, this note should be, it should be second nature to you. You should know exactly what appears in this note. Let's carry on with the trade and other payables. What else would appear here? Right. We've spoken about trade creditors. We've spoken about income received in advance, also known as deferred income. We've spoken about accrued expenses. We've also spoken about the liabilities as a result of salaries and wages. As you can see here, creditors for salaries, SARS, PAYE, pension fund. Okay. Now we come to SARS. Remember, SARS income tax, if it has a credit balance, would appear under my trade and other payables. However, if my SARS income tax has a debit balance, it would appear under my trade and other receivables. So make absolutely sure you know what's the status of the SARS income tax account. Because if I ask you the question, what type of an account is SARS income tax? Your response should be, it depends. What does it depend on? It depends on the balance in that account. If it has a debit balance, it's under trade and other receivables, credit balance, trade and other payables. Then we come to shareholders for dividends. Remember, your shareholders for dividends will always appear under trade and other payables. It means that it's a liability because you owe it to your shareholders. Okay, so what we've done now, if we've focused on few adjustments and we've highlighted ones that are normally challenging to learners, please make sure you understand them. Be able to deal with them, whether you're working in the income statement, also known as your statement of comprehensive income, and also in your balance sheet, known as your statement of financial position. So know them both and be prepared for the exams. We're going to take a quick break. We want you to just take a quick break and be back with us in a jiffy. Over to you, Luni.
Thank you, Ashraf. Matrix, we are going to take a quick break, but don't go anywhere. We'll see you straight after this. Welcome back from the break, Matrix. If you've just joined us, we are still assisting you with your final exam prep to help with the upcoming exams. If you're someone who's constantly running out of data, then this next competition is just for you. Matrix is bringing you the hashtag WazzoWinner competition, where 2 lucky matriculants stand a chance to win 2 gigs of data. All you need to do to enter is head on over to our Facebook page and all of the details will be there. Thank you so much, Ashraf, and over to you.
Thank you, Luni. Guys, I hope you had a good break. Back to the accounting. Right. Remember, we're focusing on adjustments and their treatment in the income statement as well as the balance sheet. Okay, let's look at this one here. We've dealt with rent. We've dealt with salaries and wages. Look at provision for bad debts. Okay, firstly, let's identify what type of an account is provision for bad debts. Remember, provision for bad debts is what we refer to as a negative asset. Heard that before? I'm sure you have. What do we mean by a negative asset? A negative asset reduces the value of your asset. In other words, it's trade debtors less provision for bad debts. You can see you are reducing the value of your asset. Obviously, we're taking into account the possibility of those debtors that may not settle their accounts. So obviously, we're being prudent in our approach, right? Okay, so now that we've identified the provision for bad debts, how do we deal with it in the exams? Firstly, in your trial balance, the figure that's given to you, your debtors control, is your asset, obviously, the amount of money that your debtors owe you, that's your debtors control, which is your asset account. And the negative asset that we alluded to earlier on is your provision for bad debts. So currently, you have a provision of 13,050 Rand. Got it? Okay. Now, you also have an item in your trial balance, and that is called bad debts. Now, please guys, this is important. Bad debts is a nominal account, right? And that nominal account appears under the nominal section of my trial balance. And the fact that it appears in my trial balance, it means that during the year, we've already written off an amount for bad debts, and that entry has been processed already. So therefore, it's appearing in my trial balance. Got that? Great. What are we told? Financial year end, 31st of December, right? Write off a further bad debt of 8,360. Right. Let's take that adjustment first. Immediately, you got to identify the two accounts involved. You're writing off a further bad debt. That means you're going to debit bad debts. Why? Because it's an expense. You are debiting it, and you credit your asset account, namely debtors control. In other words, this debtors control figure is going to change. And how is it going to change? You're going to subtract an amount of 8,360 from it, because it's going to reduce your debtors. These are your debtors that you've written off. That means you've made every effort to collect, but you can't collect that money anymore, so the company incurs an expense. Debit bad debts, credit debtors control. Okay? Done and dusted. Okay, then they tell you, adjust the provision for bad debts to 10,480. In other words, look at this particular question. They are telling you what your new provision must be. But remember that it always doesn't appear like that in your exam paper. There could be a question that says, adjust the provision for bad debts to a percentage of your debtors. Guys, please be careful and take note of what I'm saying, grade 12s. In this particular example, they are telling you, adjust your new provision to. They're giving you the new provision. But sometimes you are asked to adjust the provision as a percentage of your outstanding debtors. Okay guys, let's go back to our calculator now. Remember, when you are given the provision for bad debts as an adjustment in terms of a percentage, then you have to work on your debtors. In other words, what do we do? Watch this. You take your 280,000 minus the further bad debt that you've written off, which is 8,360, and that will then give you your new debtors figure. In other words, that figure will then be used and you would take a percentage of that figure to determine your new provision for bad debts. Okay, but like I said, our question, we are given the provision for bad debts. Let's just pick up our pen here, right? And we are given our provision for bad debts to be 10,480, so we know what to work with. Right, how do we deal with this in our income statement? Right, what did we do to our provision? Important question. Sometimes in accounting, you have to be a bit crazy. What do I mean by that? You got to talk to yourself and ask yourself, what did I do to my provision? In this particular case, you can see that you are decreasing your provision. Why? Your original provision was 13,050, and your new provision is 10,480. So clearly you can see you are decreasing, you are reducing your provision for bad debts. And when that happens, then remember, your provision for bad debts adjustment will appear under your operating income. By the same token, if you are increasing your provision for bad debts, then your provision for bad debts adjustment will appear as an expense under operating expenses. Keep that in mind. Don't ever miss that one. The fact that when you're increasing your provision, your adjustment is an expense. When you are decreasing your provision, your adjustment account is an income. Okay, then if you look at your bad debts, remember the 9,450 was given to you in your trial balance. Your further bad debt of 8,360 was the further bad debt that you wrote off, add the two. That operation is important to give you your final bad debts figure of 17,810. Okay, now in terms of the balance sheet, remember what we said. Take your trade debtors of 280,280 minus the bad debt of 8360. In fact, we can see this here. You remember that calculation? There you can see it. Gives you a figure of 271. Let's just pick up our pen again. The figure we're looking for here is this one here, the 271,920. That's your new debtors figure. How did you get it? You took your debtors control less the further bad debt that you had written off. Right, less your provision for bad debts. Now remember, your new provision is 10,480. The fact that you are subtracting in accounting means the use of the bracket. As you can clearly see, 10,480. And this then gives you, obviously, your net trade debtors. Okay? Got that? Brilliant. Let's move on. So these are done and dusted. We now come to loans. Remember, when it comes to loans, it's important for you to understand what we mean by a loan being capitalized, as you will see when we work with this particular question. What are we told? We are told that we have a loan from LSO Bank, right? The value of the loan is 1,725,500. That's the value of your loan. That means we have a liability to the value of 1,725,500. Okay. Information regarding the loan is important. We have fixed monthly repayments, including interest, and that amounts to 31,600 per month. Fixed monthly repayments. Remember what we said? RTFQ. Make sure you read the full question. Okay. What about the interest? It's capitalized and amounted to 242,500. Watch what I'm doing, people. I'm highlighting important information because it's going to impact on my calculation. Right? Then I'm told that interest for the next financial year, next year's interest is expected to be 162,000. Okay? And we are also told that part of the loan will be repaid within the next financial year. As you can clearly see, you are given a whole lot of information. Now, how do you use that information in order to find out what does the examiner want from you? Okay, let's look at it. The secret is a ledger account. Why? Because if you put in that information into your ledger account, clearly you're going to see where each of those items that we dealt with earlier will have to be used. Step number 1, opening balance. What was the balance of my loan at the beginning of the financial year? Here goes. There's my loan account. There's my balance. It's a liability, obviously, with a credit balance of 1,725,500. So step number 1, guys, opening balance. Got it? Okay. Number 2, we had fixed payments, right? Remember I told you it was monthly payments. Let's just go back so we can see the amount was 31,600. Obviously, if you take your 31,600 times 12, this will give you 379,200. Clearly you can see this is my 379,200. There's my 379,200. What was that? My fixed monthly repayments. Remember, which included the interest. Okay, so I've got that component in there. Next one. The next one that we have here is the the interest. I'm told that interest amounted to, for this year, the capitalized interest amounted to 242,500. Therefore, we come to my interest component. Remember, what's my double entry? Debit your interest expense, credit your loan account. It's been capitalized. In other words, the interest is going into my loan account. Watch the double entry. Debit interest expense, credit my loan account. There you can see, there's the entry that I'm referring to. How much? 242,500. Understand also, and this will also explain to you what we mean by the interest being capitalized. The interest being capitalized means that the interest is added to your loan account. Clearly you can see, there's my loan account. There's my interest on the credit side. I'm increasing my loan. The interest is being capitalized, added back to the loan account. That's what we mean by interest being capitalized. Okay, so let's recap, because a reminder is beneficial. Debit, you've got your debit your interest expense, credit your loan account. Once again, your opening balance, you've got your repayments, and you've got your interest. So you've got all three components of the loan account in its place. Okay, we move on. Now you tell yourself, fine, find your missing figure. Obviously, how are you going to find your missing figure? Simple, add up the credit side, 1,725,500 plus the 242,500 minus the 379,200 will give you a closing balance of 1,588,800. That's the closing balance of your loan account. Clearly you can see, there's my closing balance. Right, but you were also told something very important in the information that was provided. You were told that interest for the next financial year is expected to be 162,000. Let's just highlight that figure there. So clearly, it means that that information is given to you for a reason. You now have to take that into consideration in order to work out how much will your loan decrease by in the next financial year. And here goes, guys. There's your 1,725,500 minus your 379,200, as you can see, plus the 242,500, right? And then take your 379,200 minus the interest component that you will be paying next year. Let's do that. Okay? So we take 379,200 minus, was it 162,000? Let's just check. So we have the correct figure. That's right. 162,000. And that will give you a figure of 217,200. In other words, your capital repayment will be minus 217,200. Let's go back to that slide of ours. Where it goes. So there we go. We now have our final figure that we have under the non-current liability of 1,371,600. Okay? Intensive, but yes, you have to know it. So what you can see now is that we have to take a break because we've given you lots of information. Just chill, don't stray or go away. We'll see you just now. Over to you, Luni.
Thank you, Ashraf. Matrix, we are going to take a break. Before we do, don't forget to hit us up on our social media platforms. Ask us our questions on your WhatsApp line as well, so that we can assist you as best as we can. Don't forget to also enter the competition so you can stand a chance to win. We'll see you straight after the break. Welcome back from the break, Matrix. Thank you so much for joining us. We are still doing your final exam prep to help you with the upcoming exam. Thank you so much, Ashraf, and over to you.
Thank you, Luni. Guys, cash flow statements. Immediately you go into panic mode. No need to panic. Look at the question, see what is required, focus, make sure you have a system in place, and definitely it will be a piece of cake. Chocolate cake. Luni, you see my favorite? Chocolate cake. Right. Okay, guys, Here goes. We're looking at specifically the investing activities with regards to the cash flow statement. Okay, now, what information do we have? We are told, and information from the income statement is that my depreciation amounted to, let's get our depreciation there, our depreciation, let's just get the right color, here we go, there we got it. Our depreciation is 186,000. Now, let's just talk about depreciation very quickly. What is depreciation? Depreciation is what we call an imputed expense. It's an expense that does not affect the flow of funds. That is why, when you are doing note number 1, you add back your depreciation. Why? Because no money left the business. It's an imputed entry. It's a book entry. In other words, you process an entry whereby you debit depreciation and credit accumulated depreciation. But remember, no money is leaving the business. So therefore, it's an imputed expense. Right. Okay. From our balance sheet, remember. This arrow, I always talk about it as the love arrow. If a love arrow is misdirected, it creates havoc in your lives. I'm sure you had some experience. So therefore, if the arrow is incorrect in your accounting work, it's going to create havoc in your calculations. Make sure you can identify the beginning of the year and the end of the year. So you know that that's your starting point, the beginning, and that's the end. So that's the direction of your arrow, because it's important to determine what was your opening balance and what was your closing balance. Okay, so we have this here for our fixed assets, which is given to us at carrying value. Remember, what is carrying value? Cost price minus accumulated depreciation. In other words, the cost, which is your asset, minus the negative asset will give you your carrying value. Got it? Okay. So beginning of the year we've got the end of the year. We're also given a fixed deposit, which we will talk about just now. So what are we going to do now? We are told in the information provided to us that land and buildings to the value of 1,800,000 was purchased during the year. So clearly you can see that they're telling you that you purchased an asset to the value of 1,800,000. Okay. And you are told that some fixed assets were sold at carrying value. Once again, grade 12s, only in the cash flow statement will the asset be disposed of at its carrying value. Anywhere else in the question paper, you could get a profit or a loss on sale of asset. But as far as cash flow is concerned, we will dispose of the asset at its carrying value. Okay, so some of these assets were sold at carrying value. We are now expected to work out that note, the investing activities. Watch. Please remember that your note 3 in your balance sheet will be a source of reference when you are doing this particular calculation. Because if you understand your note number 3, then obviously you're going to understand what I'm doing here right now. Here goes. Your fixed assets, your carrying value, right, at the beginning of the year was, let's check, it was 4,600,000, therefore 4,600,000 when at the beginning of the financial year. You can now see the importance of that arrow. So you know that's the beginning, that's the end. Right, what else do I know? Remember, I'm putting information that I have. Then I also know that I purchased additional land and buildings to the value of 1,800,000. There's my additions at cost. Okay, now don't take for granted that it's always an addition at cost. You could get disposals of land and buildings as well. So please make sure you know exactly how to deal with what I'm referring to now. In this particular case, the question that we are talking about, there's an addition at cost. Got my addition at cost? 1,800,000. Okay, then I bring in my depreciation, and we spoke about that at length. So watch, in your calculation, your depreciation is a negative. It appears in a bracket, right? So you are subtracting it, right? Even in note number 3, you're subtracting your depreciation. Therefore, here as well, subtract your depreciation. Where am I getting the information from? From my income statement. That's correct. Remember, it said information from the income statement. Let's just draw your attention to it very quickly. Income statement, depreciation. There we go. Okay. So now we come to the other information that's provided that we have. We were told that my carrying value at the end of the year, remember, was 5,720,000 based on the previous information that was given to us. All that we do now is we determine the missing figure. And there's my disposals at carrying value. So if you start off here, remember, either you're working from the top to the bottom, either you're working in that direction, or you're working bottom up. But when you're working bottom up, it's reverse operation. Okay? And in that way, you will find, if you do your calculation correctly, you will find your disposals at carrying value to be 494,000. Right? Okay. Now that you've got that figure, because remember, you need those two components when you are doing your investing activities. So this is your calculation in order to determine that figure. Let's look at the actual note. So you start off in your investing activities by saying, purchase of tangible assets. Remember, that was given to you. You were told that you purchased land and buildings to the value of 1,800,000. Then you got your proceed. Now this proceed calculation is exactly the calculation that I showed you just now. Watch, 5,720,000 was the closing figure, plus the 186,000, reverse operation. Let me remind you once again, here, can you see, although you're subtracting working downwards, when you're working from bottom to top, it's the reverse operation. Clearly you can see that illustrated here for you. Plus the 186,000, minus the 1,800,000, minus the 4,600,000 to give me that 494,000 that I was looking for in terms of the proceed. Remember, that was what the tangible assets were sold for. So, although the purchase is an outflow of cash, and yes, people, when you are doing the cash flow statement, an outflow of cash is bracketed, and an inflow of cash is a positive figure, right? And also, remember, when you're doing the cash flow statement, other than the fixed assets, you also have to look at your fixed deposit, right? Now, let's go and see what information do we have regarding the fixed deposit. My fixed deposit at the beginning of the year was 350,000, is now 700,000. So the question that you ask yourself is, what happened to the fixed deposit? Obviously, it increased. The asset increased in value. And therefore, when an asset increases in value, we are utilizing cash. What's this here? A-I-U-L-I-G. What's that? German? Whatever you want to call it. What it means is important. When an asset increases in value, we are utilizing cash. The U tells you that that figure has to be in a bracket. You can clearly see it on the board. When an asset increases in value, we are utilizing cash. When a liability increases in value, we are generating cash. That means we are getting in cash. That's the one. The other one is this one here. ADG LDU. And what is this one here? It says when an asset is decreasing in value, we are generating cash. That means cash is coming in. And when a liability decreases in value, we are utilizing cash. Remember these two acronyms when you are doing the cash flow statement. I refer to this one here, Edgladu as the French and the Ayulir as the German. How you pronounce it is absolutely your choice. What you have to know is this is the investing activities. Okay, we now move on to the last question that we have here, and they're telling you that from 2019, the directors made a deliberate decision to change the policy on the distribution of profit in the form of dividends. Explain this change. Quote figures in your calculations. Let's look at it. You are told, you are given your earnings per share for both years, and you are given your dividends per share for both years. Okay, what do we do? This is what we do. In the first year, you take your dividends over your earnings, right? Let's just check it out so we have the right figure. You take your dividends over your earnings, and clearly you can see that they paid out 100%. Okay? In the next year, what do? You take your dividend of 33 over your earning of 60, and 33 over 60 was 55%. Clearly you can see, what did this company do? They have plans to, they've retained more income. Why have they done that? To expand as they are retaining more profit. So they do this for two reasons, either for expansion or for equalization of dividends. Well, grade 12s, the end of our show for today. But remember, focus, keep your preparation with your exam papers, and make sure that when you walk into that exam paper, you have BMT. What does that mean? Big match temperament. Because the big match is almost upon us. Until the next time, keep on practicing, be good, and everything of the best. Over to you, Luni.
Thank you, Ashraf. Matrix, thank you so much for tuning in, and thank you for joining us. I hope you guys did enjoy the lesson. Everything of the best for your exams. Please use our resources to study and to ace those exams. Congratulations to all of our competition winners who will be announced after the show on our Facebook page. Please check out our schedule on www.wozamatrix.co.za, as well as if you missed any of the lessons, they are available on our YouTube channel as well. From me, Luni, Pumza, and Ashraf, thank you and goodbye.
2020. Congratulations for being so brave, so committed, and for staying the course during one of the most difficult years in our history. We're here to support you all the way. Our Woza Matric campaign was set up to support you up until the 8th of December 2020. We are offering you interactive exam guides, shows on SABC3, DSTV, Catch Up, and OVHD Channel 122 that are not to be missed. I wish you all the best in your final exams. You are the hope and the future of our country, and we're so proud of you for coming this far. No matter the outcome, you are at the finish line. Now give it your very, very best. And I thank you.
Siyabangena. Woza Matrix is back and better than ever, with catch-up lessons, revision and learning support on more platforms than ever before. There are great support materials on the DBE Cloud. Find us on television and revise 10 subjects. And if you miss something, relax, Ntwana. Go to our YouTube channel or DSTV Catch-Up. Need help? Check out Vele, our Telegram-based chat platform where teachers are waiting to help you. Prefer WhatsApp? Send questions or voice notes to our Woza Matrix WhatsApp line. And that's not all. Want to test yourself? Check out the Matric Live app. Hey Matrix 2021, we've got you covered. Confused where to go? Visit the Woza Matrix website at wozamatrix.co.za. Woza Matrix.